Welcome to your personal deep dive.
Yeah.
Today we're going to be going over ETFs. You know, those bundles of stocks that let you invest in entire market sectors with just one single trade.
It's really cool. It's like we're not just talking about what ETFs are, but how to actually use them strategically, to maybe even boost your returns.
Right. And, some of you are probably thinking, why ETFs instead of just mutual funds? Well, one key difference, right off the bat, is the cost.
Right.
ETFs generally have lower fees, and that means more money in your pocket. Plus, they can be more tax efficient, so you keep more your gains potentially.
Yeah, that's a great point. And it's something that I think a lot of people overlook when they're kind of comparing the two.
Yeah.
Those small percentage differences in fees, they can really add up over time.
Oh, yeah, especially if you're in it for the long haul.
Yeah, especially for long-term investors.
Yeah.
The ebook gives a great example.
Right.
The Vanguard Index 500 Mutual Fund has an expense ratio of 0.18%.
Okay.
But the iShares S&P 500 ETF, which tracks the same index, comes in at just 0.09%.
Okay, so cost-wise, ETFs are looking pretty good.
Mm-hmm.
But before we dive into all the strategies and stuff, let's make sure that we're all on the same page about what exactly an ETF is.
Okay.
So I like to think of them as these pre-made baskets of stocks, almost like a diversified, mini portfolio you can just buy all at once.
That's a great analogy. And it really highlights that diversification benefit.
Right.
Instead of putting all your eggs in one basket with a single stock, you're spreading that risk across multiple companies.
Mm-hmm.
And the ebook uses the example of the S&P Small Cap 600 Value Index and the iShares ETF that tracks it.
Okay.
If you look at Figure 1 in your materials, you can actually see how closely the ETF mirrors the performance of the index.
Yeah, I remember when I first learned about ETFs and I was like, whoa, this is incredible. It's like owning a tiny slice of a whole sector of the market just in one go. And this whole mirroring thing is important because it leads us to another point, right? The incredible growth of ETFs.
Right.
These things are gaining popularity like crazy.
Yeah, it's really a shift. It's a shift in the investment landscape.
Yeah.
Mutual funds have been around for a lot longer, but these ETFs are offering some pretty compelling advantages.
Mm-hmm.
And even the big guys like Fidelity and Vanguard, they're even getting in on the action.
Yeah, it's really interesting to see.
Yeah.
So we've got cost advantages, diversification, and this enormous amount of growth. Now, let's tackle a common misconception about ETFs. Liquidity.
Okay.
Some people think that if an ETF doesn't have massive daily trading volume, that it's going to be difficult to buy or sell it.
Yeah, that's a myth that we gotta bust right now.
Yeah.
ETF liquidity, it's not just about how many shares are traded each day.
Mm-hmm.
New ETF shares can be created, to meet demand.
Okay.
So liquidity is actually tied to the liquidity of the underlying assets.
Oh, the underlying assets in the ETF basket.
Exactly.
So what you're saying is an ETF that seems like it has low volume could actually be quite easy to trade.
Exactly. Yeah. And in fact, the source material, it shares an anecdote where the expert placed a large order for what looked like a low-volume ETF and was surprised by how smoothly the order was filled.
Wow.
Yeah. So don't let that perceived low volume scare you away from, potentially good opportunities.
Really good to know.
Mm-hmm.
Okay, so we've covered all the basics. Now let's get into some actual trading strategies.
Let's do it.
The ebook features advice from Linda Bradford Rashke.
Oh, yeah.
She's a big-name trader, and she was featured in The New Market Wizards. That's got to mean something.
Yeah, her insights definitely carry weight, and she has a long track record of success. And what's interesting is she's not really a fan of day trading ETFs.
Oh, really? That's surprising. You'd think someone known for shorter-term trading would be all over these ETFs.
Right.
Why does she advise against it?
Her argument is that a lot of ETFs just don't have the kind of rapid price swings and volume that day traders need for those quick in and out trades. It's like trying to race a scooter on a Formula One track.
Right.
The vehicle just isn't built for it.
Yeah.
So instead, she advocates for kind of a more patient approach, using chart analysis on daily and weekly timeframes to identify trends and opportunities.
So it's about playing the long game with ETFs.
Precisely.
Yeah.
Yeah, her approach focuses on identifying and writing those longer-term trends rather than trying to time the market on a minute-by-minute basis.
Right.
The iShares Japan Fund, ticker symbol EWJ, is a great case study.
Okay.
And Figure 2 in the ebook shows the weekly chart of EWJ from 2000 to 2005.
Okay.
And you can really clearly see the shift from a downtrend to an uptrend.
Right. I see how those swing highs and lows are forming that pattern.
Yeah. It's about learning to read those signals, in the charts.
Yeah.
Linda emphasizes understanding those swing highs and lows, momentum divergences,
Okay.
and choosing to go long or short based on which way that trend is moving. And then figure 3 zooms in on the daily chart. And you can see a breakout from a triangle pattern, but with increasing volume, signaling the momentum is picking up.
So those visual cues are really helpful, especially for, someone like me who's still kind of learning about technical analysis.
Right.
So like once you've spotted a trend, how do you know when to actually buy or sell?
Yeah, so Linda's got some pretty clear guidelines for that.
Okay.
She waits for pullbacks within the trend to enter a position.
Okay.
Places stop-loss orders strategically based on the pattern itself.
Okay.
And uses both fixed stops and time stops to lock in profits.
So it's not just random numbers. It's all tied to the chart.
It's all tied to the chart itself, yeah.
And she's got a whole system. It's really interesting.
Yeah.
It's reassuring that, like, even someone at her level relies on those simple, classic chart analysis.
Right.
You don't need some supercomputer or some secret algorithm.
Right.
Just a solid understanding of the basic patterns.
Right. It's a powerful message, especially in today's world where we're just bombarded with so much information.
Oh, yeah.
Sometimes stripping away the complexity and focusing on those fundamentals can be like the most effective approach.
Yeah, totally.
Yeah.
Okay, so Linda is all about, classic chart analysis and writing those long-term trends.
Right.
The next expert featured in the ebook is Steve Palmquist.
Okay.
He's a full-time trader with over 20 years of experience.
Wow.
He's even got a website, daisyduggar.com.
Cool.
And a newsletter called Timely Trades Letter.
Cool.
So he seems to be kind of a wealth of practical knowledge.
Yeah, and his core belief is that we shouldn't try to force the market to do what we want.
Right.
We need to adapt to it.
Okay.
So that adaptability is really central to his approach, which he calls market adaptive trading.
So it's about being flexible and kind of adjusting your strategies based on what the market is doing.
Exactly.
You're not just being stubborn and sticking to one plan no matter what.
Right.
Like you got to be willing to adapt and change.
You got to adapt, exactly.
Yeah.
And so he identifies 3 main market modes.
Okay.
Uptrend, downtrend, and the dreaded trading range.
The dreaded trading range.
Yeah.
That's where the price is just like bouncing back and forth between support and resistance. And it's like you can't predict which way it's going to break out. It's going to be so frustrating.
Yeah. And he uses the first quarter of 2006 in the NASDAQ, shown in figure 6 of the ebook as a really good example of that.
Okay.
And he emphasizes taking quick profits when the market is like this.
That makes sense.
Using the iShares Financial Services ETF, ticker IYG, as an example.
If the market is choppy and unpredictable, you don't want to get stuck holding something when it suddenly reverses on you.
Exactly.
All right, so let's break down one of Steve's strategies that he uses effectively in those range-bound markets.
Okay.
His pullback trading strategy.
All right.
Okay, I'm all ears. What's the playbook?
So first, you need the right setup. A rapid price rise followed by a pullback, but on low volume. And then the trigger is a higher high on increasing volume.
All right.
That combo often signals the upward move is going to continue, even within the range.
It's kind of like watching a basketball player, dribbling the ball down the court.
Yeah.
They might pause or change direction slightly, but their overall momentum is still forward.
Great analogy.
Thanks.
Yeah, and the ebook illustrates this with the IYG chart.
Okay.
And you can see those false breakouts on low volume, but then on March 13th, you see that higher high on surging volume. That's the real deal.
So that volume confirmation is key.
Right.
It's like separating the real breakouts from the fake outs.
Exactly.
Yeah, that could lead to some losses.
Yeah.
Okay, interesting.
CV even has a technique for estimating volume
throughout
the trading day.
Okay.
It's all about using multipliers based on the time of day.
Wow, that's like a really practical tip that I can use right now. Like knowing when volume is typically higher or lower.
Right.
Could definitely help me make a better decision.
It's about having those tools at your fingertips to confidently assess those opportunities as they pop up.
Awesome. So now let's talk about exit strategies.
Okay.
Knowing when to sell is just as important as when to buy.
It is, yeah.
I mean, even if you pick the perfect entry point,
right,
if you don't know when to get out, you could end up giving all those gains back.
Exactly.
So what does Steve recommend?
Well, he's a big advocate for predefined exit points.
Okay.
He places his stop-loss order just below the low of the pattern.
Okay.
And his profit target depends on, the market conditions.
Okay.
So in a trading range, for example, it might be just below the high of the pattern.
Gotcha.
And he illustrates this with that IYG chart,
Okay.
using Bollinger Bands to guide his stop placement and profit targets.
Bollinger Bands. Those are those dynamic lines that kind of hug the price action, right?
Exactly.
Almost like moving support and resistance levels.
Yeah, exactly.
Okay.
They help visualize the price fluctuations, give you clues about, when the price is getting overextended or oversold.
Okay, so Steve's got the entry covered, exit covered.
Mm-hmm.
Is there anything else I need to know?
One of the biggest things he stresses is position sizing.
Okay.
Knowing how much to risk per trade.
Right.
Based on your account size and your risk tolerance.
Right.
It's about managing those potential losses.
Yeah.
And avoiding those big hits that can wipe out your games.
Like that old poker saying, don't bet more than you can afford to lose.
Exactly.
Right.
Trading is a marathon, not a sprint.
I like that.
Consistency over time is what matters.
Okay, so we've got Linda's focus on longer-term trends.
Right.
And Steve's, market adaptive approach for different market conditions.
Yeah.
What's next?
Well, let's explore something a little different. Mechanical rotation strategies.
Okay.
These are all about systematically shifting your investments between different market segments based on their performance.
Like rotating your crops.
Rotating your crops, yeah.
To keep the soil healthy and, maximize your yield.
Exactly.
So we're not just picking individual ETFs. We're creating like a system.
A whole system.
Rotating in and out of different sectors or styles.
Exactly.
Yeah.
And the ebook introduces two specific strategies.
Okay.
Basic rotation and style index.
No.
And they both aim to capture gains by shifting into those top performing segments.
Okay.
And out of the laggards.
Sounds pretty interesting. But before we dive into like the specifics, let's take a quick break and we'll come back and explore them in more detail.
Sounds good. Welcome back to our deep dive into ETF trading strategies. Before the break, we were talking about those mechanical rotation strategies, those systems for shifting your investments to try to keep up with the market's changing leadership.
Yeah, those sounded really interesting.
Yeah.
They almost seem too simple, though.
Yeah.
Like you're just rotating into like whatever assets are doing the best.
Right.
Could something this straightforward actually work?
Well, that's the beauty of these strategies. They take the emotion out of it.
All right.
Instead of trying to guess, which sectors are going to be hot or whatever, you're letting the market kind of tell you where to put your money.
So it's like having a set of rules that you follow no matter what your gut is telling you.
Exactly. And that can be super powerful,
Right.
especially when the market is volatile and, emotions are running high.
Oh, yeah, for sure.
So the ebook focuses on two specific mechanical rotation strategies.
Okay.
Basic rotation and style index.
Okay.
And both of them involve looking at past performance to make decisions about where to invest.
Okay, so walk me through how these work.
Sure.
What are the steps?
Okay, so the basic rotation strategy is pretty straightforward.
Okay.
You calculate the 6-month performance of a select group of ETFs.
Right.
Table 1 in the source material lists those ETFs.
Okay.
Then you just invest in the two that have done the best.
So every month I would look back at the past 6 months of performance, see which two ETFs are at the top, and I'd just shift my money into those.
Exactly.
Okay.
Now, the style index strategy is similar, but it uses a slightly different calculation.
Okay.
Just to be a little more responsive to recent performance trends.
So both of these strategies are about adapting, to how the market shifts and not getting stuck in, sectors or styles that are kind of lagging behind.
That's the key.
Okay, cool.
And remember, the ebook emphasizes the limitations of backtesting.
Right.
Just because a strategy worked well in the past, doesn't guarantee it's going to work in the future.
Right. The market is always changing.
Right.
But it's still helpful to see, how they performed historically.
Absolutely.
So what were the results of the backtesting?
Well, both strategies actually outperformed the S&P 500.
Really?
Over the period they were tested.
Wow. That's impressive.
Yeah, it's pretty impressive. And I imagine some people might be a little skeptical,
All right. It seems almost too simple.
I understand the skepticism, but that's precisely the point.
Okay.
Sometimes the simplest approaches can be the most effective.
Yeah.
And remember, the ebook isn't presenting these strategies as like a one-size-fits-all solution.
Right.
It's encouraging you to think about, variations. Adapt them to your own needs.
That's what I like about it. It's giving you the tools to be an independent thinker.
Right.
You're not just blindly following someone else's rules.
Exactly. So what kind of variations did they explore?
Yeah. What do they do?
Well, they tested rotating every week instead of every month,
Okay.
which led to slightly higher returns,
Okay.
but also more trading activity.
So it's a trade-off.
Right.
More gains, but you might have more trading costs.
Exactly. And they also looked at adding a bond fund to the mix,
Okay.
which is a common strategy for investors who are maybe a little more risk-averse.
Right. Bonds tend to be less volatile than stocks, so it kind of smooths out the ride a bit.
That's the idea. But there's a trade-off there, too. Adding bonds led to smoother returns overall, but it also potentially limited gains.
During, like, really strong bull markets?
Exactly. So if the stock market is, really taken off, you might miss out on some of those gains.
Because some of your money's tied up in these bonds.
Exactly. It's all about finding the right balance for your individual, risk tolerance investment goals.
Okay.
They also looked at adding international funds to the mix.
Oh, that makes sense. Diversifying across different countries and economies.
Right.
It could reduce risk.
You got it.
Yeah.
And the results were pretty compelling.
Okay.
Adding international funds significantly improved returns.
Wow.
And it actually reduced trading activity.
Oh, so it's a win-win.
Wow.
Higher returns and less trading.
Exactly.
Okay, so I'm starting to see the appeal of these mechanical rotation strategies.
Yeah.
Okay, so we've got the basic rotation and the style index strategies. And those variations, to tweak them.
Right.
What other kinds of rotations are there?
Yeah. Well, the ebook also goes into sector ETF rotation.
Okay.
Which can be a bit more aggressive,
Okay.
but also potentially more rewarding.
Okay, sector ETFs. Yeah. Remind me, what are those again?
They're ETFs that focus on specific sectors of the economy,
right?
Like technology, healthcare,
right,
energy, or financials.
So instead of investing in the broad market, you're kind of making more targeted bets on certain industries.
Exactly. And that can lead to bigger gains if you pick the right ones, but it also means you're taking on more risk because you're not as diversified.
Yeah, it's like putting more of your chips on specific numbers on the roulette wheel.
Yeah.
You could have a higher payout,
right,
but a higher chance of losing.
Exactly. Now, the ebook talks about applying that style index model that we talked about earlier to sector ETFs.
Okay.
And they actually tested it first using Fidelity sector funds.
Okay.
Because those funds have a longer track record than most sector ETFs.
So they're using the Fidelity funds as a proxy?
Right, as a proxy. Yeah.
To get a better sense of how the model would have done historically.
Exactly.
That's clever. And how did it do?
The back-tested returns were really impressive.
Okay.
It seems like the effectiveness of that model extends beyond just, broad market ETFs.
So it's like a robust model.
It seems to be, yeah.
That's great to know. But I imagine actually backtesting the sector ETFs themselves must have been a little tricky.
It was, yeah.
Given their shorter history.
Yeah, the data is much more limited.
Right.
But they did eventually test the model on iShares sector ETFs.
Okay.
And the results were strong there as well.
Okay, so sector rotation can be really powerful.
Yeah.
But it's more high risk, high reward.
Definitely.
Yeah.
Okay.
Is there anything else that we should know about it?
Yeah. What else should we know?
Well, one of the most interesting findings from the ebook is about the look-back period.
Okay.
You know how far back in time you should look at performance data to make your rotation decisions? You'd think that looking at more recent data would be better.
You would think that, right?
Like what's hot right now.
Exactly. But surprisingly, their research suggests that using a one-year look-back period was actually more effective than shorter time frames.
Really?
Yeah.
So it's not about chasing the latest fads?
Right.
It's about, those sectors that have shown strength over a longer period of time.
Exactly. It seems that focusing on those more enduring trends can lead to better results in the long run.
That's really interesting. So based on that, did they come up with a specific model?
They did. They created a simplified model where you rotate monthly.
Okay.
Based on that one-year performance of the sector ETFs.
Okay.
And the back-tested results were pretty impressive.
So even though it's simple, it seems to work pretty well.
It does, yeah. And again, the ebook, it encourages readers to think beyond just these models.
Right.
Come up with their own variations.
Yeah.
So they suggest, holding more than 2 ETFs to reduce risk, or even combining sector rotation with the style index strategy for like a more diversified approach.
Those are great ideas. So we've covered a lot about these rotation strategies.
Yeah.
What else is in store for our deep dive?
Well, before we wrap up, I think it's really important to touch back on that trading psychology.
Okay.
Remember Dr. J.D. Smith and his DOFPIC framework?
Oh, right. That acronym was so helpful for understanding the mental game.
Yes.
We covered discipline, organization, focus, patience, independence, and confidence.
Right.
So how do those apply to what we've been talking about today?
That's a great question.
Okay, so we're back for the final part of our ETF deep dive.
All right.
We've explored like all the ins and outs, why they're gaining popularity, some really smart trading strategies.
Yeah.
And now we're going to circle back to the mental game of trading.
Right.
It's so important, but I think it's often overlooked.
Yeah, it's like, having all the fancy tools and gadgets.
Right.
But if you don't know how to use them, you're not going to cook anything good.
They're not going to make a masterpiece.
Right.
That's right.
Yeah.
So you can have the best ETF strategy in the world, but if your emotions are going crazy, fear, greed, impatience, you're going to sabotage yourself.
Exactly.
Okay, so let's revisit those DOFPIC principles.
Yeah.
And see how they apply to everything we've been talking about today.
Absolutely. Let's break them down one by one.
Okay.
Starting with D-discipline.
Okay.
So this is all about having a plan and sticking to it.
Right.
No matter what.
Yeah.
Define your trading rules.
Okay.
Your entry points, your exit points, your risk management.
Right.
And commit to following them, even when it's tempting to deviate.
It's like having a budget.
Exactly.
You might want to splurge on something.
Yeah.
But if it's not in the plan, you got to resist.
Right. And it's especially important with those mechanical rotation strategies.
Oh, yeah.
They're designed to be systematic, so
Yeah.
you need the discipline to follow the rules.
You got to trust the system.
Even when one sector seems like it's going to take off.
Right.
Or you get impatient.
Yeah.
Okay, so discipline check. What's next?
Okay, what's next?
Organization.
Okay.
This is all about having a structured approach for tracking your trades.
Right.
Analyzing your performance.
Okay.
And figuring out where you can improve.
So it's not just about making the trades, it's about being detailed.
Right.
Recording them.
Yeah.
And then going back and reviewing them.
Exactly. Keep a trading journal. Use spreadsheets. Whatever works for you.
Right.
But turn it into a process.
Right. Organization helps you learn from your mistakes
And make better
better decisions going forward.
Okay, what's next?
What's next?
F, focus. This is about knowing your strength,
Okay.
your risk tolerance, and your investment goals.
Right.
Specialize.
Okay.
If you're drawn to long-term trends, maybe Linda's approach is better for you.
Mm-hmm.
If you want to adapt to different market conditions, Steve might be a better fit.
Or maybe you like those mechanical rotation systems.
Right. You don't have to be everything to everyone. Pick a lane and go with it.
Exactly. And this is where those cost and tax advantages of ETFs can really shine.
Right.
The lower fees, the tax efficiency, that can make a big difference over time.
Yep.
Especially if you're in it for the long haul.
Okay, so we got discipline, organization, focus.
What's
Patience.
patience?
This is the hard one.
This is the hardest one for most people.
Especially in today's world, right?
Especially today.
We want everything right now.
Instant gratification.
Fast food, next day delivery.
It's hard to be patient when it comes to investing, too.
Oh, yeah, it is.
It really is. But it's crucial.
Mm-hmm.
You got to resist that urge to chase every little price movement. Don't jump in and out of trades constantly.
Right.
Wait for those setups. Trust your system. And remember, wealth takes time.
It's like planting a seed.
You're waiting for it to grow into a big tree.
It doesn't happen overnight.
You can't rush it. That's right.
Exactly. Investing is the same way.
So we're cultivating patience
Yeah.
like a master gardener.
Right. So what's I?
Independent.
Independence.
This is about trusting your own gut.
Yeah, trust your own analysis and judgment.
Don't follow the crowd.
Don't follow
The talking heads on TV.
Yeah.
Or the social media hype.
Oh, the social media hype.
Everybody's an expert all of a sudden.
Right.
It's hard to tune it out.
It's hard to tune it out, but remember, you're the one who's responsible for your money and your decisions.
You got to make your own decisions.
Do your research, form your own opinions,
Right.
And stand by your choices.
Even when others disagree.
Even when people disagree, yeah.
Okay, almost there. Last one.
Last one.
What is it?
C, confidence. This is the result of all the others.
Right.
When you develop that discipline, that organization, that focus, that patience and independence, your confidence will just naturally grow.
You start to trust yourself.
You'll trust your system,
Right.
your judgment, and your ability to, navigate all the ups and downs.
It's like that feeling you get when you've trained for a marathon.
Right.
You're standing there, you're
Yeah,
like, I got this.
Yeah. Trading is a marathon, too.
Exactly.
Yeah.
So confidence is key for like staying the course and reaching your goals.
And achieving those long-term goals.
Okay, so there you have it.
Yeah.
We've gone deep on ETFs.
Yeah.
What they are, why they're important, how to use them, and we've explored the technical side
Yeah, all strategies and patterns.
The charts, the indicators.
Right.
But we also didn't forget about the human side.
Absolutely.
Trading is just as much a mental game
as a financial one.
So master those DOFPI principles and you'll be well on your way.
Exactly. And just one final thought.
Yeah, what's that?
We've mostly been talking about ETFs for growth.
But what about income?
Oh, that's a good point.
There are dividend-focused ETFs out there.
Right.
They offer a way to build passive income.
That's a good point.
Potentially less volatile.
Okay, interesting.
Might be something worth exploring.
Yeah, definitely. So there's a whole world of ETFs out there. And now you've got the knowledge and the tools
to go
navigate that world.
Yep.
All right. Happy trading, everyone.